This hearing will come to order. Without objection, all members' opening statements will be made a part of the record. The chair notes that some members may have additional questions for the first and second panel of witnesses, which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to these witnesses and to place their responses in the record. This morning, we're holding hearings on Audit the Fed, Dodd-Frank, QE3, and Federal Reserve transparency. I will yield myself 5 minutes for opening remarks. Transparency of the Fed has been an issue that I have been working on for many years. I consider it very, very important. And we have been making some progress on this. Back in the 1970s, there was a major effort made to get more transparency of the Fed, but unfortunately, it actually backfired and gave more protection to the Fed from any inquiries made by the Congress. One thing I'd like to make clear is my efforts to have more transparency of the Fed isn't equated to that of wanting Congress to manage day-to-day operations of the monetary policy. Quite frankly, I think managing of the monetary policy should be more involved with the free market of interest rates, rather than anybody believing they can manage that from a day-to-day viewpoint. Frequently, it is said that the independence of the Fed must be protected at all costs. And I usually think once there's an emphasis on independence of the Fed, it usually means the secrecy of the Fed, and it's quite a bit different. But the Fed hides behind this independence, so there's no political influence. But I think more people now are starting to realize that the Fed isn't truly independent from political influence, because indirectly and sometimes more directly it is involved in political decisions, or at least private and secret decisions made to serve some political interests. The Constitution is rather clear on if anybody's to have any oversight, it would be the Congress rather than the executive branch. The ability to do this, of course, has been hindered. The Congress created the Federal Reserve with the Federal Reserve Act of 1913, and therefore, obviously, the Congress has something to say about it. Not only did they create the Fed, but they've changed the rules. The Congress has passed laws giving instructions to the Federal Reserve. So clearly, the Congress has responsibility of oversight of the Federal Reserve. I think it's very interesting that one of the arguments for independence is that we can't allow the people to know what's going on with the banks. That if all of a sudden we knew that a bank was having a problem, that this would be bad information for the people to know about. And then that is used as an excuse to prop up certain banks and make sure bailouts occur, and that there's a lender of last resort, and there's no confusion, or otherwise no correction that might be necessary. But in many ways, the Fed performs a function exactly opposite of what the SEC is supposed to do. The SEC is a regulator that's supposed to go in and look at the books and follow some rules so that people know what's going on and get information out. But it seems like, to me at least, that the Federal Reserve does exactly the opposite. The significance of monetary policy is really the overriding issue about the Federal Reserve and what's happened since 1913, and actually what's happening today, because we're in the midst of a major crisis, and there are many of us who have come to the conclusion that the business cycle is very much related to monetary policy. So if the business cycle is related to monetary policy, this is of vital interest should be a vital interest to all of us. If we connect the two, the Federal Reserve and the business cycle, then we see that recessions and depressions are a result of the business cycle. First, you have the boom, and you have to have the correction. You have to have the bust. The other important relationship of the Federal Reserve to what Congress does, and too long it's been actually symbiotic. The Congress has been negligent in oversight, but they've been very complacent about deficits being accommodated. If the Fed was not so accommodative and always buy the debt and keep interest rates artificially low, there would be a lot more restraints on the Congress. But as long as Congress wants to spend money and they don't want to raise taxes, that's not popular, and borrowing becomes difficult, then there's a better way from their viewpoint to do it, and that is just to allow the Fed to create money out of thin air, which for those of us who believe in less government is better than more government, whether it's warfare or welfare, we see that the Federal Reserve has a strong influence in allowing our government to grow. So I am very pleased to chair this hearing today, and I'm very pleased to know that we are making progress. We didn't get a full audit last year, but we did get an audit coming out of the Dodd-Frank bill. We did get a lot of more information, and today we're going to receive more information, as well as the court cases that have come about. So compared to even 4 years ago, a lot of progress has been made in the right direction, but from my viewpoint, we have a long way to go. So I have concluded my opening statement, and do I have another member who would like to have an opening statement? Thank you very much. Okay, we'll then go ahead and start with our first panel. First panel is Ms. Oris Williams-Brown, who has spent her 21-year career in civil service at the GAO office. She is currently the managing director of GAO's financial markets and community investment team. Her portfolio of work includes banking, securities, futures, and insurance issues. Most recently, she has been responsible for leading much of GAO's work on the financial crisis, Treasury's troubled asset relief program, the Federal Reserve System and its emergency lending programs, and regulatory reform. Ms. Brown received her MBA with a concentration in finance from Virginia Tech. And I will recognize Ms. Brown for her testimony.
Thank you. Chairman Paul, ranking members of the subcommittee, I am pleased to be here today to discuss our recent report on the Federal Reserve's emergency programs. As you well know, this study was required by the Dodd-Frank Wall Street Reform and Consumer Protection Act. It is the first comprehensive assessment of the Federal Reserve's use of its emergency authorities under Section 13(3) of the Federal Reserve Act in response to the recent financial crisis. It also covers a number of programs that were carried out under Sections 10B and 14. This morning, I would like to briefly highlight a few of our findings. First, we found that the Federal Reserve and its emergency programs were subject to a number of internal and external audits. None of these audits found material weaknesses, and when issues were uncovered, the reserve banks generally addressed the deficiency in a timely manner. However, we did find that some operational audits had not been completed until the emergency programs had been operational for over a year. Second, the New York Fed was the primary player in executing most of the emergency programs authorized by the Board of Governors and the Open Market Committee. However, one program, the Term Auction Facility, was executed across all 12 Federal Reserve banks through their discount window operations. To implement and operate the various programs, the New York Fed used over 100 vendors to provide a variety of services, ranging from legal services to asset management. We found that most of the contracts were awarded non-competitively, and they were not recompeted after the period of exigency had passed. For a significant portion of vendor fees, reserve banks were reimbursed by program recipients or fees paid from program income. Third, we found that while the Federal Reserve took steps to manage conflicts of interest, opportunities exist to strengthen its policies for employees, directors, and vendors. During the crisis, the New York Fed expanded its guidance and monitoring for employee conflicts. However, while the crisis highlighted the potential for reserve banks to provide emergency assistance to a broad range of institutions, the New York Fed had not yet revised its conflict policies and procedures to more fully reflect potential conflicts that could arise with this new expanded role. Fourth, we looked at the Federal Reserve's risk management practices. We found that it took steps to mitigate the risk of loss, such as requiring collateral amounts beyond the loan exposure for the early programs and accepting only highly rated assets as collateral for some of the latter, more novel programs. For actions to assist individual institutions, it negotiated specific protections. Over time, the New York Fed expanded its risk management capabilities and started to manage risks across all programs. However, we found that neither the Reserve Bank nor the Board of Governors tracked total potential loss exposures across all emergency programs. Finally, we found that while the Board of Governors took steps to promote consistent treatment of participants, it lacked guidance and documentation for some decisions. For example, reserve banks lack documented procedures to guide decisions about restricting or denying access to the programs. We made 7 recommendations to the Board of Governors to strengthen policies for managing non-competitive vendor selections, conflicts of interest, risks related to emergency lending, and documentation of emergency program decisions. In response, the Reserve Board indicated that it recognized the benefits and would strongly consider how best to respond. In closing, I would also note that many of these programs were established during the height of the financial crisis and little public information was provided. Over time, the Board of Governors and New York Fed increased the amount of information provided to the public. And going forward, the Dodd-Frank Act requires even greater transparency and accountability for any future actions. Mr. Chairman and members of the subcommittee, this concludes my oral statement, and I would be happy to answer any questions at this time. Thank you.
Thank you very much. I will yield 5 minutes to myself for questions. Overall, having done this audit and been involved, was there any one thing that you were more frustrated with, or was there any obstacles or misunderstanding, or the law was confusing, or was this a pretty clear-cut responsibility and there weren't that many problems? How do you look at it in general?
In general, I would say that the Act laid out a pretty clear level of expectation for us in terms of what was expected, the programs that we were to cover, and exactly what aspect of the program and the operations of the programs that we were supposed to cover. So I would say it was fairly straightforward.
Okay, and this was a one-year audit. You just have to perform this one time.
Correct.
Now, would there be much of a problem if we were doing this every year, as far as accomplishing what you've done? Is this what kind of a task is this?
Well, this particular audit, while it was fairly straightforward, it was an enormous undertaking, given the number of emergency programs involved, as well as the other programs that were specifically delineated. Going forward, we'd have to keep in mind kind of the current structure that we have around our authority to perform audits. As you know, Dodd-Frank includes in Section 1102 some additional authority for us to look at any future credit facilities that the Fed may establish, and also certain open market or monetary policy activities that are delineated in the Dodd-Frank Act. So if we were asked to do those, we would, look at any particular request in turn and approach it very much the way we approach this.
And from your own experience, you've not had to look into the Federal Reserve in the way you did this time. Is this something rather unique for your experience?
Yes.
Many say that it is unnecessary to audit the Fed because they are already audited annually by an independent auditor. These audits are of the Fed's financial statements and became a legal requirement just in the late 1990s. Can you describe to us the difference between these financial audits that they'd like to say, well, they're all inclusive and we know everything, versus an audit conducted by the GAO? Could you describe the difference between the two?
Yes. GAO actually also does financial audits, but we do performance evaluations. And the audit that we did and issued in July of 2011 falls under the program evaluation performance audit arena. And the biggest difference is that we in this were asked to look at specific operational issues. We were asked to look at the operational integrity issues like internal controls over the operations of the programs. We were also asked to look at how the programs were implemented and stood up. Financial audits tend to focus on if whether or not the financial statements are being fairly and accurately presented and the controls around the financial reporting. So it tends to be kind of much broader and also more in depth.
Along that line, I want to follow up with a similar question. The Dodd-Frank GAO audit has been described as a procedural audit. It seems that most of the analysis was looking at the protocol and guidelines in place for the various emergency lending facilities. What do we know about individual transactions? How were they conducted? How collateral was evaluated? And who all had knowledge and access to the facilities and in those things in general. Are they included in the GAO's audit, or were they not part of the directives given by the Dodd-Frank, especially on the individual transactions and who knew about them and why they occurred?
Well, we were specifically asked to look at the operational aspects of the program, but that include looking at certain individual transactions, specifically when it came to assistance to individual institutions. But in terms of looking at the broad-based programs, we did look at eligibility requirements. We looked at who the largest users were of the particular programs, and we also looked at how the decision was made from the perspective of, who approved the particular emergency program. Was it the Board of Governors? Was it the Open Market Committee? And then how the particular Reserve Bank implemented the action that had been authorized by the Board of Governors or the FOMC.
Thank you. And my 5 minutes has expired, so we'll move on to the next member. And this is the gentleman from Missouri, Blaine Lukamauer. 5 minutes.
Thank you, Mr. Chairman. One of the things that's kind of concerning to me is the fact that all banks, credit unions, thrifts, what have you, they have some entity that provides oversight over them. And yet the Fed, which is the central bank, basically, I guess you would say, of our country, has very little, if any, oversight over it. In some of the things that you say here, the things that were not, because of the prohibitions, you were not able to go into, I think it's kind of interesting. Where do you think we need to draw the line on this?
GAO's position is that, this is a policy decision, and wherever the line is drawn and the bar is set for us to do whatever action, we will do what Congress asked us to do.
Okay. Along the line, with regards to the emergency loans that were done during the height of the situation we had in this country, you say in here that Federal Reserve banks required borrowers under several programs to post collateral in excess of the loan amount, programs that do not require pledge assets with high ratings, et cetera, et cetera. Did you see in the way that they handled the loans, was it in normal banking terms? In other words, did they have the normal sort of requirements for collateral excess over the loan they made, normal repayment terms, or what did you see there?
We did look at the security and collateral procedures around loans that were made, and we evaluated the process that they had in place. And we found that they did have controls around those, that they did have requirements that certain loans be over-collateralized, and in other cases there was a requirement that the collateral posted be highly rated. So there were certain controls that were built around the loans that were being made.
Did you see anything there that was of concern to you?
We didn't see anything that raised a major concern. We did point out that some of the internal audits that had been done had raised some questions around increasing the controls around the collateral, and we did look at the extent to which those had been addressed. And we found that at some point, when an issue was raised, the bank would take steps to improve the controls that were in place.
Have all these loans been paid back?
For many of the broad programs, they have been. There are outstanding loans for the 3 Maiden Lane LLCs related to the assistance to Bear Stearns and AIG.
Okay, the point I'm trying to get to here, though, is they haven't all been paid back yet.
Correct.
Your audit authority is over with. Is that correct?
Correct.
So therefore, at this point, there is no audit authority on those loans that have been paid subsequent to your audit, or those that are yet to be paid. Is that correct?
In all cases except for any that involved assistance to individual institutions.
Okay, do you think it'd be a good idea if we went back and had a requirement to audit those whenever they're all paid off, to see once everything was done according to sound financial tenets?
It's something that if we were asked to do, we would definitely do that.
That's a policy decision, right?
Yes.
Okay. Okay, very good. With regards to the open market operations of the Fed, one of the things it says here is that they are not required to disclose their operations until 2 years after they take place. How do you get a hold of information that's pertinent, that's time sensitive, that we can actually get a good job of seeing what everything's going on here? If you can't do it within a 2-year time frame, that seems almost beyond the ability to sort of implement any sort of controls or corrections.
Well, we would note that in the audit that we did that was issued in July, it was done in many cases less than a 2-year time period.
Okay, I got one more question real quickly. With regards to the swap lines of things that they have with foreign banks, were you able to do anything at all with oversight over that? Were you able to look into any of the activities along those lines?
We did. That was one of the specific programs listed under our authority in Dodd-Frank. We basically looked at how they were structured. We found that the Fed had engaged in a number of swap line transactions with foreign central banks. And the biggest takeaway was that once the Fed engaged in the swap with the foreign central bank, any activity of the central bank, the foreign central bank, was really, from the Fed's perspective, that was the central bank's responsibility, and the foreign central bank assumed any credit risk from the activities that it engaged in.
Okay, if the chairman will bear with me, just one more question. Do you see any risk to the Fed with that way that's structured right now?
Well, that's one program that remains open, and the authority for that program is open through August of 2012. It was one of the programs that had been extended. And, as with swaps, there's, currency risk associated with currency swap type of transactions.
Okay, I see my time's up. Thank you, Mr. Chairman, for indulgence.
Thank you. Now I yield 5 minutes to Congresswoman Hayworth from New York.
Thank you, Mr. Chairman, and thank you for conducting this hearing. Thank you, Ms. Williams-Brown, for being with us. There's a notable statement in the GAO report that some Federal Reserve Board decisions to extend credit to certain borrowers were not fully documented. And I was wondering if you could elaborate on that. What sort of documentation would you like to have seen? Was there an explanation as to why the documentation was lacking?
Well, In the area of documentation, kind of prior to Dodd-Frank, there wasn't an explicit requirement for the Fed to document its decisions. So from an audit perspective, that often presents a challenge in determining exactly what happened. So that requires us to have a number of conversations with the relevant players. But what we noted is with the programs, there were generally broad eligibility requirements, and institutions that were generally considered to be in good financial condition were able to participate in a particular program. But to the extent that there were exceptions that didn't necessarily appear to coincide with the particular process in place, we had to have conversations to find out kind of why things happen. One example is with the commercial paper lending facility. An AIG subsidiary was allowed to participate in, to continue to participate in the facility, even though they no longer met the new requirements, and that is that they had been an active participant in the commercial paper market, but they were still allowed to participate in the facility.
Is there further work ongoing to determine why that was allowed to occur, or?
No.
So that now lies with us, I guess, here too.
Yeah. And we did make a recommendation to the Fed kind of going forward that if they were to engage in credit facilities or any emergency lending in the future, that it's important to document decisions. And the Dodd-Frank Act now has a reporting requirement. So we pointed out that in order to fulfill that reporting requirement in the future, there's documentation that has to go along with the decision making.
In order to
report
encourage
it.
And presumably to encourage sound decision making.
Yes.
So that we're not doing things that don't make sense fiscally.
Yes, that, and to be able to then report to the Congress, you know, what was being done and why.
All right. Well, thank you, Ms. Williams-Brown. I appreciate that. Mr. Chairman, I yield back the remainder of my time.
I now yield 5 minutes to the Congressman from Arizona, Mr. Schweikert.
Thank you, Mr. Chairman. And it's Ms. Williams-Brown. Part of this is actually, and my good friend from New York was almost touching on parts of this. First, on the emergency facilities, were you able to take a look at how well documented the requests were? The systemization of the decision making. And part of where I'm leading on this is just sort of your opinion, you know, when you're playing auditor. If we were to have another hiccup, do they have mechanical rules and steps that are consistent? What did you see?
Well, at the retrospective audit, there weren't requirements for them to document specific decision points. So from that perspective, it required us to go back and attempt to reconstruct how decisions were made. The going forward, there are new requirements in terms of being able to report out that should help provide some additional structure around it, and that's one of the things that we also spoke to in some of our recommendations.
I've heard some discussions about, even before, of some of the new requirements, but do they seem to now have been adopted in sort of if you and I were to lay out a flow chart of saying, here's our decision-making process, with you and I also understanding this may be a process that sometimes has to be done very quickly.
Correct.
But it also helps to know what check boxes you're going through, saying, okay, we have this, we have this, we have this, and I mean, from what you're seeing, have those documentation requirements, the new ones, been built into the system?
Well, I will say, since July, we haven't gone back to update the status of the recommendations that we made, so I can't say if they have addressed the recommendations that we made, for example, for a better documentation process. So that's not something I'm in a position today to say that they have or have not done those types of things.
Okay. Mr. Chairman, Ms. Williams-Brown, with that, because where I'm sort of hunting is how did they document what assets were being pledged, future forward, what was being swapped, and how well that was sort of locked in, saying yes, you're pledging this, and once you've pledged it, you can't go and touch it anywhere else. And we also have a proper mechanics telling us any exposure, like are there any sort of where these assets may have also lent out their value to other pledges. I'm trying to understand the decision tree, but also the quality of the documentation on assets pledged.
Now, in terms of kind of pledging collateral and tracking that, we did look at the control process around the collateral process. And we did specific drill downs on 2 of the facilities that that borrowers were able to pledge a wide variety of collateral for a single loan. And we did a drill down to look at the collateral that was pledged, and we also did some independent evaluation and testing to make sure that those controls around those were operational. So there was a process around that.
When you were looking at some of that, did you find some of the assets didn't really ultimately the market value add up to what they were put into in the pledge?
We looked at really kind of the pricing of the collateral, and we found in a small percent of cases, somewhere around 2%, that there was some discrepancy in the price of the particular collateral that we tracked versus what was included in the data that we had gotten from the Federal Reserve. But we did not find any type of systematic bias one way or the other in terms of how that collateral had been priced.
But only about 2%.
It was a fairly small percentage, yes.
I'm surprised. And would some of that have been MBS? Mortgage-backed securities?
Right.
Because the way you would price it?
Was it? I think it cut across a variety of the types of collateral that had been posted.
Last one, and I'm partially doing this from writing and see if I find in my notes. And this one may be almost asking more of an opinion. Inspector General for the Fed, I think, has also been given additional duties to Consumer Finance Protection Bureau. So they're almost wearing 2 hats, even though they're now separated. Any opinion on does that mechanically work?
That's not something we've specifically looked at. So I'm not in a position to offer an opinion.
No, gosh darn on that one. Mr. Chairman, yield back my time. Thank you.
Thank the gentleman. I yield 5 minutes now to the gentleman from Michigan, Mr. Heitzinga.
Well, thank you, Mr. Chairman. And I just want to appreciate, or want to express my appreciation for you holding this hearing. I think this is very important. I appreciate your time coming in as well. And I won't plan on using this full 5 minutes, but I am struck by the theme that we're hearing of a need for oversight. And I don't want to put words in your mouth, but that's certainly sort of the tone that I'm catching. That this is a good thing that we should that has happened. I think it's up to us then to decide whether this is something that we should continue. It seems to me we should. I am curious a bit about if you could unpack, and I apologize if you had to step out for a phone call, but maybe you touched on this, but I wonder if you could unpack a little bit about what some of the lending facilities were used by branches and subsidiaries of foreign banks, and were you really able to determine why several of those emergency lending facilities were primarily used by foreign institutions? And I wonder if you could talk a little bit about that.
We did look at the largest users across the facilities, and we did find that there are certain facilities that tended to be used by the branches and agencies of foreign banks. And in conversations and following up with the Federal Reserve about the reason for that, we found that usually the largest lenders of facilities were driven by kind of the composition of the market. So if it's a market that there were major foreign banks that had branches and agencies in the U.S., they would have been as likely as a U.S. bank to tap a particular facility.
And so that wasn't necessarily a region when you're saying that. It could be a product line or
product line or a particular market that they were active in, because many of the broad-based programs were aimed at a particular disruption that was going on in a particular market. Commercial paper, some of the money market mutual funds had also experienced problems.
And could you characterize sort of the ratio of domestic versus the foreign?
It really varies by program, and I'd be more than happy to provide a breakdown for each facility for the record.
That would be great. How many facilities, as you're using the term facility, how many facilities are there? How many breakdowns do you think that would be?
10, 11 facilities. There were, I think it was somewhere in kind of the 10 to 12 range.
Okay. Right. We appreciate the follow-up on that, so thank you.
Absolutely.
Thank you, Mr. Chairman. Appreciate that. We'll yield back.
Thank you. And now I yield additional time for a follow-up question to the gentleman from Missouri, Mr. Lukemeyer.
Thank you, Mr. Chairman. I'd like to follow up just a little bit more on the swap line discussion we had a minute ago. Can you tell me how many times the line has been used, or is it just beyond just number of times per day, or has it just been only 3 or 4 times in the last 6 or 8 months?
I'm not sure that we tracked it by the number of times used, but we focused on the number of foreign central banks that were permitted to participate in the swap line. And there it would have been through the July timeframe.
And do you have an idea of how many times that was?
I don't.
We had the chairman in here not too long ago, and he indicated that there was almost zero activity.
Well, I will say that when we issued our report as of the end of June, the balance on the swap lines was zero. Okay. At that time. So they had been used and repaid.
And looking at those transactions, did you see anything in there that would pose a risk to the Fed or therefore our taxpayers?
I think the potential for, because the Fed would be swapping dollars for a foreign currency with an agreement that the foreign central bank would reverse the swap at the same rate that the other, to the extent that rates had moved, there's a potential risk built into.
Okay. Did you see where it's a pass-through from other existing banks over in Europe through the central bank there, or was it just a direct swap through the European Central Bank?
Well, it was, once the swap happened with the particular central bank that the Fed engaged in the swap activity with, the Federal Reserve didn't track what happened to those dollars once they were in the hands of the foreign
okay, so basically there's a firewall then between the transaction and wherever else those monies would go to. Those other dollars would flow to. Is that
right.
Is that a fair statement?
I guess I'm pausing on the firewall, but there is definitely a separation.
Okay,
yes.
there's no tangible liability exposure to us from one of the other banks in Europe that's going to be passed through the European Central Bank. I guess that's a better way to phrase the question.
The central bank would assume that risk.
Okay, so there basically then is no other risk that we've assumed, the Fed's assumed, from those activities.
Right, beyond the swap.
Okay, and the only risk that you see there is just the normal currency activity of the daily ups and downs of the value of the currency itself. Or is there other things in the transaction that worry you?
There could potentially be others, but that was the one that kind of immediately comes to mind.
That's the biggest risk?
I would say that's the one that immediately comes to mind for me. And I do have a total on the number of transactions, 569. That's how many transactions there were.
Between what time period?
This would have been from the beginning of the program through June 29th, 2011.
Really? Okay. One more quick question. In your report, you indicate that there is the GO found that conflict of interest policies could be strengthened. Can you give an example of where there's a conflict of interest that you found that there's a problem or exposure or concern?
Well, we found a number that raised issues. They raised an appearance of a conflict, and one had to do with senior Federal Reserve Bank of New York officials they held stock in some of the institutions that had received assistance. AIG was one example.
Did you see a pattern with individuals or with particular companies, particular entities, like through AIG or other companies or other entities that were out there that they were trying to work with? Or
I wouldn't say we observed any type of pattern. We observed with the vendors that there were situations that the Federal Reserve Bank of New York, for example, could have taken additional steps to strengthen their management of conflicts of interest that may have existed within vendors, and done additional oversight of what the vendors were actually doing to make sure that they weren't exposed to conflicts.
Okay, very good. Thank you, Mr. Chairman. Appreciate the second round.
Thank you, and I now yield for follow-up question to Mr. Schweikert from Arizona.
And forgive me, I just want to make sure I was listening carefully to Congressman Lukemeyer. On facilities that were with foreign central banks, was there a currency risk on when the assets were moved back?
Well, that issue really comes up on the dollar swap lines, because that's actually a swap of U.S. dollars for current foreign currency with the agreement to reverse the swap.
It would be an unusual instrument to unwind it back to the value of the previous swap if there'd been movement in the currencies. That's sort of defeats the purpose of it.
Well, I mean, it's kind of the nature of a swap, that you agree to exchange the currency and reverse it at a particular price at a particular date in the future.
Okay. So there was, from what you were seeing, is there was always a pledge on the value at the end?
For the dollar swap lines only.
Yeah, no, that was
Right.
the only one I was interested in.
Mm-hmm.
Second of all, and I know this is a little on the annoying side, but if you would have one of your staff reach out to our office sometime in the next couple of weeks, we'd love sort of in writing to be able to chase down, as you were saying, that it was 2% that you saw that of pledged assets that you thought sort of may have been outliers. And this is one of those occasions I have to go through my file cabinet and find an article from a couple months ago that I think was talking about specifically private label MBS that may have been pledged that may have been much further in a dispute of what its true value was. And I'm just trying to get my head around having sort of read one thing and now in testimony making sure I'm using the same definitions there.
Well, and it's not only an issue of the same definitions, but this is something that could vary from facility to facility. And my comment was specific to 2 credit facilities, but this could actually be the case in one of the others.
It absolutely would be that way.
Yeah.
I mean, it would absolutely be that way. And if there was 500 some different ones, as I think I just heard you say.
For the transactions for the dollar swap lines,
yeah.
yes.
Okay. Last one is also, as long as we're asking you to throw something into notes, so that Inspector General comment before. I know this really isn't your area, but I'd love someone, if you know if there's a policy statement or somewhere in the agency in regards whether this really works to have one Inspector General sort of doing both the consumer finance protection and the Fed, even though they now wear very sort of separate hats. And with that, Mr. Chairman, I yield back and thank you.
Thank you. Does anybody else care for any follow-up questions? If not, I want to thank the witness for appearing, and also, without objection, your written statement will be made part of the record, and you are now dismissed, and the second panel may come to the table.
Thank you.
We will now receive testimony from our second panel. Our first panelist, Dr. Robert Auerbach, is Professor of Public Affairs at the LBJ School of Public Affairs at the University of Texas in Austin. He was an economist with the House of Representatives Financial Services Committee, formerly the Banking and Finance and Urban Affairs, for 11 years. He assisted Chairman Henry Royce in the 70s and the 80s and Chairman Henry Gonzalez in the 90s with oversight of the Fed, spanning 4 Fed chairmen, Burns, Miller, Volcker, and Greenspan. He is the author of the book, Deception and Abuse at the Fed. He received 2 master's degrees in economics, one from the University of Chicago and one from Roosevelt University under Abba Lerner. He received his PhD in economics from the University of Chicago, where he studied under Milton Friedman. Our second panelist is Dr. Mark Calabria, who is the Director of Financial Regulation Studies at the Cato Institute. Prior to joining Cato in 2009, he spent 7 years as a member of the senior professional staff of the Senate Committee on Banking, Housing, and Urban Affairs, where he handled issues relating to housing, mortgage finance, economics, banking, and insurance. Dr. Calabria has served as Deputy Assistant Secretary for Regulatory Affairs at the Department of Housing and Urban Development and has been a research associate with the U.S. Census Bureau's Center for Economic Studies. He is a frequent contributor to the New York Post, National Review, and Investors Business Daily, and frequently appears on CNBC, Bloomberg, Fox Business, BBC, and BNN. He received his PhD in economics from George Mason University. I would like to now recognize this second panel, and also under unanimous consent, your written testimony will be placed in the record. So I recognize Mr. Auerbach, Dr. Auerbach.
Sorry about that. Thank you very much, Chairman Ron Paul, and the members of this committee. I'm honored to come back here where I worked for 11 years. One thing you left out, I also worked in the Reagan administration, saying the same things in between the periods I worked here at the Treasury Department. I want to talk about the transparency at the Fed. The Fed is the powerful central bank of the United States that controls the money supply, regulates the banking system, and since 1962 makes loans to foreign banks without congressional authorization. The historical record of Federal Reserve officials blocking transparency and individual accountability, including destroying source records of its policymaking committee since 1995, is clear. I want to especially thank Chairman Ron Paul and Senator Bernie Sanders for finally getting some kind of an audit at the Federal Reserve in the Dodd-Frank Act. In 1976, when I was here, I assisted Henry Royce in putting up an audit bill at the Fed. The Fed immediately mounted a huge lobbying campaign using the bankers that it regulates to come to Washington and go into all the offices here and stop the audit. Chairman Royce went to the floor of the House later when we got direct evidence of how the Fed used their offices and their facilities to organize the bankers they regulate to come to the Congress and lobby. Finally, the bill was, a couple of years later, 1978, was passed down the hall at the Government Operations Committee with 2 glaring no audit parts of the bill. One is anything to do with monetary policy or international transactions at the Fed. Let me just talk one moment about those 2 areas. In the monetary policy area, there are tremendous opportunities to make billions of dollars on inside information from the many leaks of Fed monetary policy, which I helped the committee investigate for many years. Let me just give you one little taste of it. First of all, Greenspan said, after a number of leaks when the newspapers were publishing what they had said the previous day in their secret meetings, that were beginning to look like a bunch of buffoons. They had at those secret meetings at the Kansas City Fed, where I used to work, central bankers from Bulgaria, China, Czech Republic, Hungary, Poland, Romania, and Russia attending and listening to interest rate information that they would not give the Congress at that time. Finally, the Federal Reserve decided that they would not like to have any more minutes public of their Central Policy Making Committee. That was Arthur Burns in 1976 from a law then that was being passed, Government in the Sunshine Law, and a suit from a student at a university in Washington, D.C. So the Fed voted then, 1976, 10-to-1 vote, that they would no longer have any transcripts of their Central Policy Making Committee. And it's a 10-to-1 vote, and the 17-year lie began. Finally, in 1992, I came back for the second time, and I spoke with the great Henry B., as they call him in his district in San Antonio. How could it be that the most powerful central bank in the world had no transcripts of its meetings that they used to send out? What happened to them? So Mr. Gonzalez had all the Fed presidents come, all but two showed up. Greenspan sat in the middle, right where I'm sitting, members of the Board of Governors on each side, and they misled the Congress. We put a lot of heat on them because they were federal witnesses, and a few days later the Cleveland Fed broke and said, well, they had had a meeting 4 days earlier where they decided how they'd mislead the Congress. And I just have one person at that meeting, the staff person, a very good staff person who used to work with me at the Kansas City Fed, but he was assisting Greenspan, said the chairman is not highlighting these transcripts. We're not waving red flags. And when Congressman Morris Hinchy had asked him at the hearing right here, do you have any records? And he said, just some notes we keep. Well, after that, Greenspan sent a letter over here and said, well, actually, this is 17 years later, we have those transcripts. And I took a group of Republican and Democratic staffers over to the Board of Governors, found them right around the corner from Greenspan's office, neatly typed. And so they decided then that they'd start issuing the transcripts again after a 5-year lag, much too long for timely accountability. And after I left the committee, went down to Texas, I read that they had decided in 1995 to shred the records of the Federal Open Market Committee. They had been kept, those transcripts had been kept and sent to the National Archives, but they decided to destroy them. So I wrote a letter to Alan Greenspan asking why they're doing that, and his vice chairman, very good person inside the Fed. These are good people. They just have bad policies. Donald Cohn, who's worked there for many years and became vice chairman, started at the Kansas City Fed. He wrote to me, yes, we've decided to destroy the transcripts of our meetings, but we think it's legal. I just want to go through a few other things on the audits so you can get an idea of how bad the audits have been of the Fed. Just two little points. One is the Los Angeles branch of the Kansas City Fed. You can ask me questions about it. When we found out that the auditing system there was corrupt, and I took an excellent GAO team, I was a liaison, went in there and found that the system was completely corrupt. And Greenspan admitted in a letter to the committee that they knew that the employees of the Fed had stolen at least $500,000 in the previous 10 years from the vault system of the 12 banks. And one other thing, and then I'll quit. The airplane fleet of the Fed, 50-plus airplanes. The audit there was a joke. There was no audit. The people running the fleet in Boston used to laugh about it, and they appeared here. Mr. Castle allowed them to come, and they were very courageous, and they talked about it right in the committee room here. And Carolyn Maloney, Congressman Maloney, helped in investigating them. That was a completely corrupted thing. It was typified by their backup plane the Fed paid for in Teterboro Airport that didn't exist most of the time. Now, that's all I want to say. I have two other points. One is about paying off all the economists throughout academia, an investigation of Henry B. Gonzalez, and what I consider malpractice, the present policy, monetary policy of the Fed that was begun in October 2008 that's caused a lot of unemployment in the United States.
Thank you. We'll go to Dr. Calabria now.
Chairman Paul, distinguished members of the subcommittee, I thank you for the invitation to appear at today's important hearing. As the subcommittee is well aware, the events of 2008 witnessed not only unprecedented disruptions to our financial markets, but also extraordinary responses on the part of our financial regulators and central bank. No entity was more deeply involved in the Federal Reserve System, particularly the New York Federal Reserve. Yet the Fed has consistently and repeatedly resisted efforts to bring accountability and transparency to its actions. Congress and the public were repeatedly warned that if details of the Fed's actions became public, further panic would ensue in our financial markets. Yet when that information, such as AIG's derivatives counterparties, finally did become public, disruptions were minimal or non-existent. Despite some notable attempts by the Fed to increase its communications with the public, I believe given its track record, the public cannot rely on the Fed to voluntarily provide us with sufficient information to monitor activities and judge the effectiveness of its actions. And while the requirements of the Dodd-Frank Act in relation to auditing the Fed's activities are an important advance, they fall too short of providing sufficient oversight of the Federal Reserve. What auditing has been conducted so far has been focused on the Fed's response to the crisis. Accordingly, much of the audit requirements in Dodd-Frank have something of an historical feel about them. However, it is not enough just to get history right, although we're lucky if we do that, but also to ensure that future mistakes are avoided. I can think of few areas requiring as much mistake avoidance as monetary policy. The Fed's role in helping to create the crisis via its easy money policies in the aftermath of the dot-com bubble and the events of 9/11 remain largely uninvestigated by Congress. If we truly wish to end financial crises, then I believe it's absolutely essential that Congress receive a full and objective evaluation of the Fed's role in fostering the housing bubble, particularly as it relates to monetary policy decisions between 2002 and 2005. Disagreement as to the appropriate stance of current monetary policy, I think, also demonstrates Congress's need for objective, independent analysis of monetary policy. Some might object that a GAO audit of the Fed subjects the Fed to political pressure. I think that such an objection ignores the simple fact that GAO is not a political organization. As mentioned, I served as staff on the Banking Committee for a number of years. I can say through all of my interactions with the GAO, they are independent, they are unbiased, they are non-political. I have not always agreed with the conclusions of the GAO, but I have never felt that any of those disagreements were the result of politics or bias. I think the subcommittee should also keep in mind that GAO exists for a very simple reason. that no member of Congress or their staff are fully knowledgeable about the functioning of all the various government agencies. GAO simply exists to inform. I would argue that there are few areas less understood than monetary policy and macroeconomics. Hence, I would argue there are few areas more in need of an audit than monetary policy and macroeconomics. Again, the purpose of GAO here is to try to provide some information so that members can more actively engage, I think, and more effectively engage in oversight of the Federal Reserve. Another objection to a GAO audit of the Fed is that such would compromise the Fed's independence and subject it to political influence. I think such an objection confuses the very nature of Fed independence. The Fed's authority to regulate the value of money is one that is delegated from Congress. As Congress can and has legislated changes to the Fed, it should be beyond a doubt that the Fed is not independent of Congress. It is quite the opposite. It is a creature of Congress, and Congress has every right in that avenue to interject and regulate the activities of the Fed itself. Setting aside the debate over the desirability and legitimacy of so-called independent agencies, it should be clear that their independence in any operational sense is supposed to be from the executive branch, not from Congress. It should also be clear, however, that in recent years the Federal Reserve has coordinated its actions quite closely with the Treasury Department, in my opinion, eroding any independence from the Treasury. The revolving door, both at the political and career levels between the Federal Reserve and the Treasury Department, further undermines the Fed's operational independence. I believe a GAO audit would help shine a light on this relationship, actually helping to insulate the Federal Reserve from continued interference by the Treasury Department. Again, the Dodd-Frank Act has made important advances in bringing transparency and accountability to the Federal Reserve. Unfortunately, it falls short in allowing Congress and the public to truly gauge the effectiveness of the Federal Reserve. In order to improve Federal Reserve transparency, I would suggest that Congress mandate a regular audit of all Federal Reserve activities, including monetary policy. Such audits could be performed in a manner so to minimize the disruptions to any ongoing deliberations of the Federal Open Market Committee. For instance, these audits could be kept confidential for a short amount of time, 6 months, a year. That's certainly something that could be done not to try to unduly influence ongoing activities. But again, those audits should be made public at some point. I think it's also important to emphasize evaluating the effectiveness of any government agency is made all the more difficult when that agency faces a variety of competing and sometimes conflicting objectives. If the Federal Reserve feels it's free to abandon price stability in order to achieve other objectives, such as rescuing the financial industry or misguided attempts to influence the labor market, then I believe the value of an audit may potentially be very limited. At a minimum, Congress should consider restricting the Federal Reserve to a single goal, that of price stability. Congress should also restrict the ability of the Fed to have discretion in implementing that goal. On a very basic level, a central bank that is free to define price stability, to define its own objective, is a central bank without any meaningful constraint. With that, again, I thank the chairman, I thank the subcommittee, and I look forward to your questions.
Thank you very much. I yield myself 5 minutes for questioning. First question is for Dr. Calabria. And I want you to follow up. I know you've talked about it in your statement, but follow up on this relationship of the Fed and the Treasury. And you indicate that if there's to be any oversight or any connection, it's more with the Congress than with the executive branch and the Treasury. Could you talk a little bit more about that and exactly what do you mean, and what has happened in the past that might suggest that we should be looking into the relationship of Treasury and the Fed, and how that could be a negative, or why some people think it's a positive?
Well, there are a variety of different things, and I'll touch on, maybe I will most directly touch on first the negotiation and implementation of Dodd-Frank. Treasury was the point person in negotiating Dodd-Frank for the administration, yet several of the senior advisors at Treasury representing the administration were staff on loan from the Federal Reserve. So again, I think many of us remember there was about a whole 5 minutes during the Dodd-Frank negotiations where maybe there really were going to be serious restraints on the Federal Reserve, where there would be a serious examination of their bank supervision, regulatory powers. Again, I think the Congress and GAO should take a look at whether the Fed should be supervising banks in general, and whether that conflicts and provides any conflict of interest with their monetary policy decisions. But having essentially Federal Reserve staff at Treasury negotiating on behalf of the administration certainly, in my opinion, meant that there was going to be no chance that Congress was actually going to be able to peel back any of the powers of the Federal Reserve. So again, the Treasury relies very heavily on Federal Reserve expertise and legislative decision-making. Most importantly, however, and it's important to keep in mind, that Fed independence really came out of this Treasury-Fed accord where prior to the 60s, the Federal Reserve supported Treasury prices, essentially, and tried to maintain the price of long-term Treasuries in order so that the Treasury Department could more easily and more cheaply fund its activities. And again, if you have this relationship, and you see this particularly with the second round of quantitative easing, where the amount that the Fed were purchasing on a monthly basis was coincidentally very close to the amount that was being issued by the Treasury. And so to the extent that we go down that road of potentially monetarizing the debt, which I think is the ultimate concern, that you have the Treasury market supported by the Federal Reserve, which of course reduces discipline on not only the Treasury, but reduces discipline on Congress to get its fiscal house in order. So again, we rely on the markets to send us signals, and the Treasury market should be sending us a signal that we're headed to a financial train wreck. But it's of course not, because the Federal Reserve is intervening in that market to reduce the price signal that we'd be receiving. So that's an important part of the debt market, I think, is ultimately one of the more important aspects of this. But again, you also see it in financial regulation. I want to emphasize again, the nature of independence is supposed to be not from Congress, but from the executive branch. There is a variety of literature, for instance, in economics that talks about a political business cycle where you would see the Federal Reserve try to loosen monetary policy in expectation of presidential elections. Again, I would say that the empirical results in this literature are mixed, but again, the emphasis is on the administration. We know that in terms of any president's reelection, it's going to be far more important what the Fed does compared to what any member of Congress wants. So again, there's far different interests and far different incentives in Congress where you have a unified incentive in the executive branch. So I would emphasize again, the importance is to draw some independence from the executive branch in the Federal Reserve rather than from Congress.
So just in summary, the way I understand that is when they talk about independence, they're really not talking about independence. They want to eliminate the role of the Congress, which you're arguing has a responsibility. So they want to be excluded from that supervision, but they don't want to be independent from the Treasury. What about political or private interest influence? I mean, when the bailouts came, there had to have been some special interest and political interest. Would that could that be said to be not independent either, but influenced by not only the Treasury but outside interests? Do you think should there be concern about that?
I think there's a very absolutely strong concern about that, on several levels. I mean, one could just look at monetary policy, where monetary policy is conducted in partnership with the Federal Reserve's primary dealers, in which it buys and sells Treasury securities with to conduct its monetary policy. Well, of course, if you're doing bank supervision, you've got a financial crisis, and these primary dealers find themselves in trouble, the Federal Reserve has an incentive to try to essentially make sure that those primary dealers survive. And of course, it doesn't want to make any of that public. I'm sure you could ask any of the largest firms that were assisted, whether it was a Goldman or whether it was Societe Generale, they have not welcomed the attention that they've gotten when all of this information has come out. We heard a little bit earlier about the GAO report. One of the things that struck me is if you look through the tables and you look through the information of the GAO report, regardless of the program, it's the same companies that keep repeatedly coming up. Repeatedly we see Citi, repeatedly we see Bank of America, repeatedly we say Morgan Stanley. Regardless of the program, it seems to be that the concentration of the benefits of these programs are with a handful of corporations. And of course, those corporations, I think, do not want the public attention, but they have repeatedly received incredible assistance from the Federal Reserve, or credible assistance that's been off budget. So again, that relationship and that revolving door, we've seen it. And again, this is something that was talked about in Dodd-Frank, some of the governance issues. We all remember very much the role of Goldman essentially being the chair of the board at the New York Fed, and some of the conflict of interest there. And certainly goes worth saying that the current president of the New York Fed is a former Goldman employee. So not only am I concerned about the revolving door between Treasury and the Fed, I'm also very concerned about the revolving door between Wall Street and the Fed.
Thank you. I yield 5 minutes to Mr. Lukemeyer from Missouri.
Thank you, Mr. Chairman. Dr. Auerbach, in your testimony, you mentioned 2 or 3 things here. The LA Fed, whenever there was some corruption that was exposed and some folks stole some money, the Federal Airplane or the Federal Reserve airplane fleet. The audits that are being performed or should be performed, would they have caught these abuses?
Did the audits have abuses?
No, did the audit with the audits that are being proposed? In other words, right now we've got the Inspector General folks here at GAO were here a minute ago, and they're now doing an audit on the emergency loan program that was administered.
They don't touch any of these.
They don't touch any of these things. They'll say,
and that's
you're saying we should expand the existing
definitely.
audit procedures because existing audit procedures are not catching these things?
Definitely. There's tremendous problems inside the Fed, and the in-house audits were no good at the Boston Fed. The courageous people there that testified right here about it said that someone came up from upstairs at the Boston Fed near the harbor. The officials of the Fed are at the top. People that run the airplane fleet were down below. And somebody came down, is everything all right here? That was about the extent of the in-house audit. And there were all kinds of corruptions. And so many corruptions that Henry Gonzalez, the chairman, asked me to call the Janet Reno Justice Department, which I did, and they didn't want to get into it. Nobody likes to attack the Fed in Washington. So they said, call the Inspector General of the Fed, which I did. Very nice man, Brent Bowen. And he said, well, I don't know if I have jurisdiction up in Boston. And that's one of the major problems of the Fed and this new consumer agency that's located, Consumer Protection Agency located inside the Fed. The IG of the Federal Reserve is appointed by the head of the Federal Reserve. So how can he investigate these things? Bernanke cannot be investigated, and his officials, by the person they appoint. This should be a presidential appointment and an independent IG at the Fed if you want to start cleaning up this mess.
Do you think there's anything that should be off limits whenever it comes to disclosure of the Fed activities?
That's a very interesting question because the Fed is now shredding their documents, but Arthur Burns, who was the head of the Fed back in the 70s, he died 1987, and he sent his transcripts of the meetings up to the University of Michigan, the Ford Library, and they had people from the National Archivists, professional archivists, took out anything that had to do with national security, personnel. They were lightly edited. So I was able to go up there and get copies of them all. They're very different than the kind of thing that the Fed issues. Ask any reporter that's received something from the Fed. It's mostly blanked out.
Redacted.
That was a much better record. And what should be done now is that the Fed should be told, you cannot destroy those records. They go to the National Archives after 30 years. There'll be somebody looking at that. And also, on these FOIA requests, you should get professional archivists that know the rules in cooperation with the Fed instead of sending reporters blank pages.
Okay, Dr. Clavier, what do you think about that? There are some things that you believe they should not be disclosed or off limits, or you think everything is open to everything?
I think the way I would look at it is the question of when should it be disclosed. Ultimately, any sort of deliberations, any sort of economic forecasts should be disclosed at some point. I would be comfortable having some sort of time lag. For instance, one of the things that Dodd-Frank does, and I think does correctly, despite that much of what the bill doesn't do correctly, is require a disclosure of future discount window lending. And so the concern from the Federal Reserve would be if you disclose at the time that banks are coming to the discount window, that is a signal that such banks are weak. And I think that's a legitimate concern to raise. But I think if you, and again, in Dodd-Frank, it allows up to 2-year delay for that disclosure. I would prefer something closer to a year, but I would say a 6-month, a year delay on something like discount window is legitimate in that it will not scare away people from using the discount window. Of course, we can have a totally separate discussion of whether there should be a lender of last resort in a discount window. But again, if you're going to have one and you want it to be effective, a delay of disclosure in that, I think, is reasonable. A delay of disclosure on deliberations at the Federal Open Market Committee meetings, I think, are, again, reasonable. Ultimately, in a timely basis, all of this information should be made public, and I want to emphasize, 5-10 years is not timely. So again, we need to get out in a reasonable amount of time.
Thank you. I yield back. Thank you, Mr. Chairman.
I thank the gentleman, and we'll go into a second series of questioning. This question is for Dr. Arbach, and it has to do with what you talked about when you were trying to get an audit in the 70s, and you didn't get too far in the banking committee, even though it was the chairman of the banking committee that wanted to do it. And then they took it and they sent it over to the Government Operations Committee. And then when they, gave the authority for the audit, it was, actually exactly the opposite and closed that. I wanted you to expand on that. And also, why don't you tell me why it is that the individuals either in the Fed or see to it that their people get in the Fed, how come they have this much power that they have, that they're able to control even the banking committee chairman and then pass legislation, exactly opposite of it? And I think it was at that time that they really put into it. It seems like where the greatest protection is on these foreign operations. I think that's where there's a lot of mischief. And even now with our partial audit, we hear about it, but we don't know exactly what transpired. Could you expand on that a little bit?
Sure. Let me take the second part first on international operations. You were right about the bill that was finally passed, where the GAO is not allowed to go into anything that has to do with the operations, international operations, or monetary policy, trophies that remained on the shelf of the Fed for a long time. In international operations, when the Fed goes, for instance, and notifies brokers all over the world, brokers who are not, they are not investigated by anybody in the United States, and tells them we want to buy, say, 5 billion in euros. That information is given to the brokers ahead of time. And I'm not saying the brokers are dishonest, but when there's billions at stake in these markets, they can place orders, or people in their office can place orders, long before the order is consummated. So we wrote, the chairman wrote to Alan Greenspan and said, why are you doing this? Why not just make an announcement that you're going in with 5 billion and let everybody in the market get in on it at the same time? And he wrote back, well, I think there's only about a 10-minute delay between the time we tell them to do it and they make these huge purchases. Well, that's ample enough to make a lot of money in the market. And so the international operations should be audited by the GAO. It's a really important, and I think they should, when the Fed is going to do something, they should announce it. And I disagree a little bit with Dr. Calabria. I would not leave these decisions for discount rate changes and for anything the Federal Open Market Committee does for more than 6 months. Even that is very long, because there have been so many leaks at the Fed. The FBI has been called in, all the rest. It's going to leak out anyway. There are several ways it leaks out. One is when we ask how many people at the Fed know about these secret interest rate decisions, we got a whole bunch of pages, single-spaced, of hundreds of people all over the country on these conference calls. And as Greenspan reported, he was saying he opens the Singapore edition of the Wall Street Journal and found out what the Fed did at their meetings before. So you can't tie up information that's so valuable for months and that just benefits inside traders. And those trophies, when they did go over and put them in there, it kept the GAO out of a lot of the problems. And can I say one other thing that I think is important? We have sitting in the audience Walter Charlton, who's had suits against the GAO since 1983 because the GAO has had a policy, alleged policy, of, I had excellent people that were at the Los Angeles Fed that did the audits. They were excellent. They were old-timers at the Fed that knew how a central bank works and knew what to get into and what to look at. The suits now in the courts all these years, some of them have been adjudicated. Some of the people that the suits allege they try to get rid of the older people. In a recent suit, I gather that after a joint session of Congress, 200 were rehired by the GAO. But they try to get rid of the old people, people that are 55 or older, around there, and hire young people. And I know they hire young people because I used to have lunch with David Walker when he came to the LBJ school to get some of our excellent young students. But that lowers the amount they have to pay the people by a huge amount. But what we need in the GAO are experienced auditors that know how central banks work and can get in there and really find out what's going on. That takes a lot of training to find out how do you do a vault facility. The vault facility, since we found that team that was in there that I worked with, was excellent. And they found out what was missing it was just awful. The main ledger of the vault on a computer, everybody could get in there without a password. What happened to those officials when that thing went public? Nothing has happened since then at the Fed. And I think it's very important to get better GAO auditors. Now, maybe they have them that are experienced in how to audit a huge, enormous central bank with 20,000 employees, and they have vaults all over the country that hold all the money for the commercial banks, and the Bureau of Engraving ships it there. All the new money's in there also. It's a national security problem, and if Greenspan thought the employees were stealing $500,000 in 10 years, we thought that was a tremendous understatement, and so did that Fed, the GAO crew. But I don't believe shortly thereafter most of them were no longer at the GAO.
Thank you. I yield 5 minutes to Mr. Lukemeyer.
Thank you, Mr. Chairman. I have a feeling that both you gentlemen have got a lot more to say and a lot more suggestions for us, so I think I'll just use my time a little differently this time. Dr. Calabria, you're the Director of Financial Regulatory Studies. What one regulation would you suggest that we as a Congress, as a committee start out with, or as Congress, try and put together that would be impactful? Is it, audit the full Fed, or are there something else that you see that could really, protect our monetary system and really make an impact? What would be your suggestion?
Well, I think the focus really needs to be on defining and limiting the discretion for the Fed on price stability. So, again, you could do things like eliminate the dual mandate, having some sort of inflation targeting. I would emphasize that ultimately what's going to be a constraint on the Fed is some sort of competition. So obviously encouraging alternative monetary mechanisms is something we should be looking at in the long run, but certainly trying to find a way to constrain the Fed. So I'd have a full audit. I would get rid of the dual mandate. I would put some statutory flesh around what exactly price stability means. Because again, you could get rid of the dual mandate, but if the Fed decides that price stability is 3 or 4%, then it doesn't really matter. You have to take some of these definitions back into Congress. And again, I want to emphasize, one of the reasons I think that the Federal Reserve has been so effective over the years at thwarting Congress is that they come up here and they give you all this gobbledygook about, M1, M2 and all this, and they try to confuse you. And again, the most important thing is to get information out there so that members of Congress can even start with the very right questions and can push them, and basically not let them get around that. So, most important thing we can do is to educate Congress and public on how exactly monetary policy works.
Very good. Asked for one and got three. Must be DC. Thank you. Dr. Harbach, with regards to the same question, you've had a lot of advice for us in some of your previous comments here. What piece of advice or regulation would you suggest?
Well, price stability is certainly important, but the Fed should understand it's the 1949 Employment Act that said they have to do full employment also, that price stability helps produce full employment. And right now, we have quite a bit of inflation. Year over year, 1 month it was 4%, then 5%. Then Bernanke testified that he doesn't see any inflation. How high does it have to go before he sees it? That's year over year inflation. And the other thing that I think the Congress should have something to say about is what I call malpractice at the Fed. In September 2008, when Lehman Brothers collapsed and the markets went crazy all over the world, 1 month later, the Fed decided that they'd start paying the banks interest in order for them to hold their reserves. I have that diagram. I wonder if you put it up, of the amount of, there it is there, the amount of excess reserve. You'll notice that since the this is the Federal Reserve of St. Louis, it's zero. All of a sudden in 2010, the banks, they're intelligent. They say, look, we can get a 0.25% interest, risk-free from the Fed. Why should we loan it to businesses? So the Fed began pumping in their monetary base. They pumped in $1.9 trillion. How much of that got out for loans to banks and to businesses? 1.7 trillion was parked as excess reserves, is there today. Out of that, the total today is 1.6 trillion in excess reserve. 1.6 trillion. It went through the roof. Now we're in a position today where people inside the Fed, economists inside the Fed, like William Gavin, a great economist at the St. Louis Fed, published in their literature, for the banks, it's a much better investment to hold the money as excess reserves, tie it up, than to lend it out to people, because you get a 0.25% for sure. We're in a terrible environment. What should be done immediately, I call this malpractice that certainly increased unemployment in the United States. The Fed must stop paying the banks to hold reserves instead of lending it to businesses. And if they do that, they've got to be very careful that the money supply doesn't balloon out or we'll have a huge inflation. They will have to slightly raise their target interest rate to about 0.5%. They should be doing that. They've been at zero long enough, and you can see what good that has done for the country.
Thank you very much. I yield back.
Thank you. I have one more question for the two of you. We talk about the transparency and how to get information out and how dangerous it is if somebody gets the information, they can make some money on it because they anticipate what the market will do. And also there's so often the unintended consequences of manipulating what they do, the economic consequences. And we talk and discuss, and there was a slight disagreement on exactly when we release information, when did the Fed do this, and when do we get a record of the history. My question is a little bit different. It has actually to do with monetary policy per se, not how we tell how the Fed manages monetary policy. From my viewpoint, see, they've had two mandates, full employment, and I don't think either one of you sort of enjoy that. Employment, if you really look at the old-fashioned way of measuring, it's probably over 20%. And then Dr. Arbach admitted that price stability, they're not doing very well there. I sort of got the indication from both of you that it wasn't the principle of setting the interest rates, it's how they do it and when it's released and the details of it. But what about the question of whether or not they should be messing around with interest rates? You know, most economists these days, ever since the 70s, they sort of have played down wage and price controls. Wage and price controls aren't very good as a solution to solve the problem of price inflation created by too much money. But setting interest rates is a pretty big deal. I mean, if prices are the signal that tells the businessman what to do and the consumer what to do, the supply and demand, and of course, free market economists predicted that socialism would absolutely fail without a pricing structure. But why is it that we've accepted this idea that the Fed is all-knowing with their record? So could you each tell me that, do you think it would be bad to have a system where the Fed wasn't involved with setting interest rates, and maybe market rates would help? Maybe market rates would help savings. You know, maybe interest rates would go up, and the people who tend not to want to gamble in the stock market and the bond market, wouldn't this be a help to economy? Could both of you just make a comment about whether or not the Fed should be setting interest rates?
Well, I think that's a really good question. And in 1979, we had a little party right here in this room, and the new chairman was coming on board. He was a very good chairman, Volcker. And at that time, by 1980, the inflation in the United States was going over 13%. Interest rates went up over 20%. There were mass bankruptcies in the country. And Volcker was laughing with us and said to two of us from the University of Chicago, "You give me a pain in my you-know-what." And we laughed together. But then Volcker decided he wouldn't control interest rates. He would control the money supply and stop printing so much money, which he did. He paid a big price, but he stopped the country from going into a terrible inflation. We had a double dip. I was in the Reagan administration, and we had a double dip recession, 10% unemployed, but then we had a long period of no inflation. So he did a great job. We paid a terrible price. But when Alan Greenspan came in, the idea of controlling the money supply was considered, oh, that's University of Chicago monetarists, and they don't know what they're doing. So by the end of the 1980s, he decided the Fed would no longer target money. He would do what other central banks do, just target the interest rates. I think they should do both. They should watch the money supply, but they should do what Congressman Paul said, try to let the interest rates go to market interest rates instead of sitting on them.
I would start by saying that I believe there's probably no more important price in the economy than the interest rate. I mean, you really do balance savings and investment, and you balance time preferences. And accordingly, when we get that wrong, we get a whole lot wrong, and you can have all sorts of disruptions to the economy. So ultimately, the answer should be a very strong no. We should not have the Fed be manipulating what is the most important price in the economy.
I thank the panel for appearing, and this committee is now adjourned.